During the past year, 25% of net inflows to ETFs went to smart beta strategies. Also known as advanced, strategic, and alternative beta, smart beta incorporates the best of passive and active investing. The number of ways for investors to use smart beta are growing. Rules-driven and transparent, smart beta strategies offer exposure to factors that are long-term drivers to asset class returns, helping to deliver higher, more stable returns at a lower cost. In this multimedia companion to institutional investors' special report on smart beta, we speak with 5 leading providers about why this strategy is getting so much attention and how it's changing the way investors allocate their portfolios to more effectively manage risk and achieve returns. Lynn Blake, the CIO of Global Equity Beta Solutions at State Street Global Advisors, says that as investors have become more sophisticated, they've started seeking strategies that are better suited to achieving their objectives. That evolution has resulted in greater scrutiny of both active and passive strategies. Advanced Beta, which is the moniker State Street Global Advisors uses for the strategy, offers investors a third alternative, according to Blake.
So we see investors, in some cases, replacing their core passive or allocating advanced beta to their core passive, where they really see it as an attractive complement to their cap-weighted index strategies. And in some cases, we see investors that have become disillusioned with cap-weighted indexes. What's driving that disillusionment is the belief that cap-weighted indexes are inherently flawed and they're inefficient because of their allocation to stocks that have either higher valuations or more exposure to large cap companies. Alternatively, we also see investors replacing active management, traditional long-only active managers, with advanced beta strategies. And that is really driven by the fact that active management in aggregate has had a very difficult time outperforming the index, particularly after fees and transaction costs. So advanced beta strategies offer the alternative. They offer the potential for higher performance and or lower risk.
Cal Gaillard, head of active beta equity strategies at Goldman Sachs Asset Management, explains how a smart beta strategy works.
Broadly speaking, smart beta is an index-like portfolio that is not weighted by market capitalization. But in practice, there is much more to these long-only equity strategies. So in general, smart beta investing seeks to gain an efficient exposure to common equity factors such as value, momentum, quality, size, low volatility, through rules-based, non-cap-weighted portfolios that aim to generate positive excess returns over the long run. While there are active managers who outperform the market with pure alpha on a factor-adjusted basis, there are many others whose outperformance relative to the market, that is the traditional alpha, can largely be explained by exposures to one or more common factors. So smart beta strategies, which seek to deliver an efficient capture of common factors, can thus be viewed as a passive alternative to factor-based active management. Additionally, for investors with predominantly index exposure on a market cap basis, smart beta strategies can potentially add sources of outperformance while typically providing more transparency, simplicity, and lower fees compared to active management.
Depending on an investor's objectives, there could be a number of combinations and strategies. Sarah Shores, Managing Director and Head of Strategic Beta at BlackRock, says that 3 or 4 years ago, investors were asking for one factor, like low volatility or equal weight. Now it's about allocation to combinations of risk factors.
We spend a lot of our time working with clients to help them understand how to combine risk factors together to come up with a more diversified portfolio that helps implement their investment view. Because many of these ideas are really driven by very distinct market anomalies or risk premia, they tend to pay off at different times in the business cycle and have a very low correlation with each other that tends to stay low during crisis periods. So they're very logical. It's very useful in a portfolio construction sense to combine these multiple factors together. It gives you a very well-diversified outcome that tends to be lowly correlated with other sources of return in their portfolio.
Ronan Israel, a principal at AQR Capital Management, says that smart beta investing lies on a spectrum.
We feel that you can move along the spectrum, and to the extent that you are comfortable with these additional concepts, you can get a more efficient portfolio. First, what you can do is you can not just focus on one style, you can add multiple styles to your portfolio so that you diversify along the style dimension and you capture a more efficient return. Then you can move into multiple asset classes. Instead of just focusing on equities, for example, you can go beyond equities and try to apply these styles to multiple asset classes. And then finally, you can move to a long-short framework where you're able to capture these returns in a more efficient way and one that is diversifying to a traditional portfolio. Ultimately, you can put all of these things together and you can have a multi-style, multi-asset class, long-short portfolio, which we think is a very diversifying and very efficient way to capture these ideas.
Ronan goes on to give an example of how applying smart beta to multiple factors, asset classes, and strategies can offer greater diversification.
When you move beyond equities and move beyond just long-only style tilt portfolios, you recognize that these long-term sources of return, like value and momentum and carry, these different styles that we talk about in our article, they can be applied in asset classes beyond just equities. And there's a diversification benefit of applying these styles in multiple asset classes. In other words, a portfolio, for example, that goes long cheap stocks and short expensive stocks is not super highly correlated with one that goes long cheap currencies and short expensive currencies. So you're able to get a diversification benefit by applying these styles in multiple different contexts and to have a more broadly diversified portfolio of styles.
Ronald Kahn, Managing Director and Global Head of Scientific Equity Research at BlackRock, says that increased allocations to smart beta strategies will have implications for active managers.
If you look at what active managers deliver, it turns out that roughly a third on average, as equity managers, roughly a third of what they deliver currently is smart beta. Now, that's on average, and some active managers do more and some do less. But smart beta is a disruptive innovation for active management. It takes a third of what we do on average and packages it in a simple, transparent, and low-cost form. What active managers need to do is focus on the part of active returns that aren't smart beta. Investors need those returns, and the best active managers, I believe, will focus increasingly on just delivering those returns since smart beta is increasingly available elsewhere.
When applied, smart beta can be used to solve problems by addressing specific investment issues strategically. But Sarah Shores notes that many investors need help in figuring out how to integrate the strategy into traditional asset allocation models.
One of the things investors struggle most with is how to integrate smart beta ideas with their existing methods of asset allocation and portfolio construction, which are generally more anchored to geographic asset classes, traditional sectors, and style box investing. Some investors have crossed that chasm and really think of asset allocation along risk factor dimensions, but for others, we need to help them bridge that gap.
To take best advantage of smart beta strategies, SSGA's Lynn Blake says it's critical for investors to define their objectives, have a long-term investment horizon, and maintain conviction.
We think it's critical that an investor has an investment thesis, that they really have a belief in these factors, and whether the empirical evidence that has been experienced in the past in terms of higher return and lower risk will carry forward in the future, and an investment thesis on why that's the case, whether it's risk premia or somehow behavioral based, and the fact that it will continue in the future. Because if the investor really does not have that conviction, then they may opt out or liquidate these positions at the wrong time.
To learn more about Smart Beta and to hear from all 10 of the industry leaders who contributed to the report, we invite you to read it online or download the PDF and read it offline.